All right, all right, all right. Good evening, and welcome to Your Money Matters, a financial empowerment show where we are discussing every single week the intangibles or the tangibles of making sure that we can move the culture forward with financial empowerment, right? Every week, we've been doing something different where we are talking with professionals about moving the culture forward as it pertains to money and finance, right? Things that we weren't taught in school, things that we need to improve on in our communities as it pertains to money, right? So the first week, we got our mindset right, our money mindset together, where we spoke with someone who talked about wealth building strategies and principles, right? And then last week, we had someone get us prepared for income taxes, right? The tax returns, what you need to know. This week, we wanted to do um, how to build a strong financial house, right? Realistically, we struggle in these areas because no one's teaching us how to do these things, right? So we've positioned ourselves and we have a very special co host who's going to take us on a journey along with me as licensed financial coaches to show you some of the principles that it takes to build a strong financial house. So I'm going to introduce my guest. His name is Mr. Lenny White, and he's a close personal friend of mine. We've been in business together for a minute, doing the same thing, helping to empower people as it pertains to money and finance. Mr. Lenny White is a senior regional leader in a financial service company from Atlantic City, New Jersey. With a college degree from Hampton University at HBCU, right? He started working in the casino slash hotel business, and then he started his own business part time, where he started out 1 to 2 days a week, got promoted several times, and is now on track to be a $300,000 earner by helping and shape and develop others in the financial services industry. He is a full time agent and he's been helping people. He's one of my mentors. So I figured it was only right to have him to co host this show with me today. So I am excited, ecstatic, Lenny, to have you on the show. Mr. Lenny White, how are you today?
I'm doing well, Letha. Good to see you and good to be
Likewise.
in front of your audience this evening. I want to say thank you publicly for the opportunity just to share a little bit and talk to some of your audience members and some of the people that you might have listening in. So it's a pleasure.
Absolutely, absolutely. So, just tell a little bit more about what intrigued you about getting into financial services and how you decided, like, what was your motivation to get going to start impacting others in the world of money and finance.
Well, it was a couple pivotal moments. I like to call them magical moments in my life. The first one being when I was very, very young. I am dating myself, but I used to buy and sell comic books, and I used to mark the price of the comic books up. And when I was a young boy, and I understood from a very early age that people paid for convenience. Anyone could have went to the same store I went to and got those same comic books, but they didn't want to do that. So that was my little part-time little hustle when I was a young boy, maybe 7, 8 years old. Then
Okay.
later on, I got to be a little older, and I live in Atlantic City. Not currently, but I'm from Atlantic City. And my father took me on a bike ride, and we got to see some of the bigger houses that are historically on our downbeat section. These are $1 million homes, 2 and 3 and 4 million dollar homes in the downshore area. And I asked my dad, as we were just riding our bikes, what do these people do? And he told me they don't have a job. And my question to him, now I didn't dare say this, Letha, but my question to him was, well, why do you have one? I didn't dare ask that question,
I
but
know you
that's what a 9-year-old might think of.
sure.
Then another moment happened to me when I was in school. I was at Hampton. I was taking a business law class, and I met with my professor after class to ask him some questions. And I also wanted to know what type of business did he run. And he said that he didn't run a business. He was a professor at the university. I said, well, if I go over to the nursing department, they're real nurses teaching those nursing students. If I go to the to the architectural building, there are real live architects in there teaching the architectural students. And I said, you're here teaching business and you don't have a business. I find that a little strange. I didn't say that, but that's how I felt. I felt a little strange. So those were three pivotal moments that made my decision or crystallized my decision that I wanted to be in business for myself as a young person.
Okay. All right. Very good. So you kind of learned from the examples of others what you didn't want to do, right?
Yes, yes, I did.
Absolutely, absolutely. So, Lenny, I invited you on for your knowledge base as it pertains to the topic at hand. I try to get people who have some experience and some knowledge in areas. So I know we do some partnerships and things together. So I found it only fitting for you to be on and kind of talk to the people about what it takes to build a strong financial house. What does that look like? Because I think for a lot of people, we tend to turn the financial house upside down, where we are doing everything the wrong way because we choose to live in an extravagant fashion. Consequently, we don't have money saved. Consequently, we're behind the eight ball probably about 250 years from other groups because we have not mastered how to build a strong financial house. So as licensed financial coaches, I felt convicted and wanted to definitely share, if I'm going to have a platform, to share what it takes to build a strong financial house. So I'm going to, if we can, pull up the picture of the financial house so that people can get an idea of what that looks like. Leslie, if you would pull up the financial house. So, absolutely. So, as you can see here, that you want to build your financial house from the ground up, right? And the foundation of a financial house, you can see the layers here, right? You want to protect your income, you want to build a budget or an emergency fund, a will, getting out of debt, retirement, college savings, other goals and dreams, right? But when I said we flip the house upside down, a lot of us are living other goals and dreams, and we don't have the bottom half right to secure the financial house. So consequently, when there's a snafu, the whole financial house crumbles, right? So we wanted to look at the financial house, but this is going to be a 3-part series so that we can learn all the layers, but the most important layer is life insurance, right? So protecting your income with life insurance, you get an opportunity to rent an estate until you can grow one, and then you build your financial house the correct way so that if God forbid something happens and there's a premature passing, your whole financial house doesn't crumble, right, Lynn?
Absolutely, absolutely, Etha. In building a solid financial house, life insurance is the foundation. It certainly is one of the first things that you need to have in place, and that is one of the topics that I'm very, very passionate about. Because I've learned over time that there's 364 million people in America, and about 70 million people in the United States of America, the richest country on the face of the history on the face of planet Earth historically, don't
Mm-hmm.
have life insurance. But those same people, they have auto insurance, they have health insurance. Some people might even have cell phone insurance where they might drop their iPhone and crack the screen so they can get a replaced iPhone. Most people who are homeowners, they have obviously homeowners insurance, but there's a whole disconnect as it relates to life insurance. People just don't understand that fundamentally it's one of the foundations of building generational wealth. There's really only a couple ways of building financial security for your family.
Mhm.
The first way and the easiest way and the most inexpensive way is through life insurance. I mean, if you had a business in your family, someone would give you a business. That'd be great. If you had a rich uncle, that certainly would be great. But if you don't have either one of those things, you don't have a rich uncle, no one's giving you a business, you might need to have life insurance in place so you can start that lineage of financial success in your family. So, life insurance is the fundamental ground floor footprint of any financial game plan simply because, Letha, it's the only bill that you're ever going to pay that's ever going to put money back in your house in an untimely demise. So you might not get into a car accident, but you pay car insurance every month.
Mm.
Your house might not burn down, but you pay homeowners insurance with your mortgage every month. You might not drop your cell phone on the concrete and your cell phone might not crack. You might not get COVID where you might need to utilize your health insurance, but we're certainly going to expire, AKA check out of here, one day using or borrowing the phrase from my old hotel experience. Everybody's going to check out. When you do check out, how's your family left behind? And if you build a solid financial house, and I like to use the three little pigs. There's a nursery rhyme or kid story that the three little pigs were afraid of the big bad wolf. Well, the big bad wolf is called life. Here, it's called
Mhm.
life, and it really depends on how you build that house. Now, one little piggy built his house out of straw, and when life came or the big bad wolf came, blew the straw house down, and that little piggy went to his brother's house. Well, that financial house was made out of clay or whatever it was made of. It wasn't a really secure home or
Mhm.
really bulletproof financial game plan. So when life came blowing, they blew that house down, and the two other little piggies ran to the other brother's house. I believe the story goes. Well, that house was built out of brick. And remember the story: the big bad wolf, aka life, huffed and puffed but could not blow that house down. So we
Mm.
all want to have a bulletproof home financially, and we want to have a house that's made out of brick. So when life does come, and it will, to blow your house down, you'll be in a secure place so that you can move your family forward. That's kind of how I like to explain it.
Absolutely. That was the inspiration for the flyer that I posted. Was the is your financial house strong or is it weak? And to put it in terms that people can pay attention to, if something, God forbid, happens to your income and there's a premature passing, your house is easily going to be blown down if you don't have the proper coverage. Realistically, life insurance is great for people if you trying to get buried, but realistically it is to benefit the people who are left behind that are mourning not just you, but then they end up mourning your paycheck because there's nothing in place, so that financial house crumbles. And some of the statistics that we talk about have something to do with single moms or mothers, period, where they struggle within 6 months of a breadwinner passing away, where they either got to sell the house or they got to downsize or they got to go live in big mama's house or whatever the case may be, because there was no proper planning to stop these things from happening. So their financial house was completely blown down in the early years when you're trying to build your nest egg or you're trying to build your savings. The death of a breadwinner can really make the whole house crumble if you don't have enough money to cushion. So we say rent an estate until you can grow one. That solves the problem of what happens if I pass away too soon or if I live a really long time. What are some of the other statistics or things that you've seen when it comes to people not having the proper protection?
Well, there's a great hesitation in the life insurance arena, and it has been historically, because there's, believe it or not, Letha, there are some people in certain segments of our population that thinks that if you buy life insurance, they're so skeptical about the purchase of a life insurance program, or they're so just put upon that they might actually die. They're really, really in some sort of way that they think that, well, if I purchase the life insurance, I'm going to die. And that's
That's a
so
terrible.
far from the truth.
Oh my goodness.
I mean,
I've heard.
I'm searching for the term, but there's a term for it when people are just afraid, right?
Right.
But I,
Right.
I challenged those people. I said, well, were you afraid that you were going to get into a car accident when you bought car insurance? They said,
Right.
no, I'm a good driver. I said,
Hmm.
well, were you afraid that you were going to smoke in the bed and burn your house down when you got homeowners insurance? They said, no, I don't smoke. Do you live in a flood area? They said, no, I don't. I said, so why would you be afraid in the purchase of something that was certain to happen? Why, that just doesn't make sense to me. Another thing that I've learned in my time in the industry is that people just really aren't educated on the proper types of life insurance, the different types, how they work, how one could benefit you way more than others. And then there's a
Hmm.
lot of hesitation in our particularly in our community. There's a lot of hesitation simply because we know people who have purchased life insurance, but there was really no escape.
Hmm.
The whole thing with GoFundMe is not life insurance, ladies and gentlemen. The
It's
GoFundMe
not.
is not life insurance. But some people find themselves, even when they have life insurance, not having enough coverage,
Hmm.
or the money has been figured out a way to been taken from you, siphoned from you.
Mm.
And there's a lot of hesitation because people, our grandparents, our great grandparents, some of us bought life insurance, but where was the inheritance? Where was
Absolutely.
the inheritance? So I certainly, understand part of it, but without proper education on actually how it works in the right type to purchase, some people may find themselves, with these reasons for not purchasing.
Absolutely. One of those things. We look back. I come from a family where they swear by life insurance, right? Consequently, they got life insurance, but they got the wrong kind. So
I did
still
too.
no wealth was passed, right? I just look at how different my life would be, and generationally how things would be if we were properly educated, but it was systematically designed for us not to be, right?
Correct.
If you weren't light skinned enough, you cannot get the kind of coverage that would pass wealth, right? So systematic racism was even in life insurance, where if your skin wasn't light enough, you couldn't grow, you couldn't leave any kind of inheritance, but they didn't want to pay for you to get in the ground. So they came through and marketed. You'll hear people say, so that you could get your funeral services paid for, and it's so much more than that. It's
Absolutely.
about who are you leaving behind. Are you replacing your income so that they don't struggle? It's way more than after, when you're just getting buried. And so we had the insurance man that came by, my mom's guy. His name was Big Jim. Big Jim would come by. He would eat our food. He would
Yeah.
sit on TV. He built rapport
Yeah.
so that he could lock in loyalty with my mother. And the whole time he had sold her something that 9 times out of 10 he did not have himself, because
Absolutely.
he understood that you don't pass wealth through certain types of insurance. One of the other myths that I've seen, well, not a myth, but people think if they have job insurance that they're good, right? So I have it on my
Another one.
job. I have it on my job. First of all, that job doesn't necessarily belong to you. If you quit, get fired, furloughed, laid off, you automatically lose that coverage. So that doesn't belong to you.
If
And then,
you're on FMLA, there's another
oh, yeah,
one. If you're on FMLA, it doesn't cover you.
Right. And then they're only giving you 1 to 2 years of your salary, right?
Correct.
So you got a 2 year old. What does the 2 year old do till they're 18 when you've only left behind 1 to 2 years of your salary? So, people, we are going to be talking about the kind of insurance that can position you to pass wealth and educate you on some of the ones that, have historically left us passing poverty in our community for decades, right? So, I'd like to show the theory of decreasing responsibility and why there are certain types of life insurance, namely whole life insurance, that you shouldn't be paying on for your whole life, right? So, the theory of decreasing responsibility, I think, will help people to understand, not that one. It looks like two lines. We're queuing up the images that we have for you all today.
Now, it's
Nope.
the same one that she had up there with
That
the
one,
red house. It's at the top of the
yeah,
red
the one
house, I
with
believe.
the red house is that one.
There it is.
So we teach that you don't need to pay on something your whole life. So, Lenny, talk to the folks about the theory of decreasing responsibility.
It's a really novel concept, but it's very, very fundamental. A lot of companies and a lot of industries try to convolute their products and services so that they're difficult to understand. So if you have someone in a situation where they don't understand the verbiage or the language, they can get over and sell you something that might not be to your benefit. But
Mhm.
life insurance is very, very simple, ladies and gentlemen. So I'm going to do an example here real quick. At the top of the screen, you'll see two lines that intersect. You'll see a green line. We're going to call that line your insurance line. And then you see a gold line. We're going to call that line your money line, right? And somewhere along the way, the lines are going to intersect, and I'm going to explain to you briefly why they do. So let's talk about just insurance. I love to use car insurance because we all have to have it if we're driving a car. Does that make sense to you, Letha?
Absolutely.
Hopefully it's coming through that makes sense to your audience. So if you look at your green line, imagine your green line being a brand new luxury automobile. Now, when you finance a brand new luxury automobile, they mandate that you get full coverage insurance. So
Absolutely.
you have a lot of insurance because you don't own the vehicle. And the bank wants to ensure that this vehicle gets paid for and the bank receives their money.
Mhm.
So let's talk about a 25-year-old as being a brand new luxury automobile, right? See, when you're 25 and you have young children, if you look right underneath the green line, young children, high debt, you might be in search of a mortgage. See, a loss of your income when you're in your younger years. What are your younger years? 25, 35, 45 years old. Those are your younger years. That's when you're raising your children, maybe your grandchildren. That's when you're purchasing your first home, maybe your second. And a loss of your income during those years would be devastating to your family. See, when you lose a loved one, you not only lose the loved one, but you lose the loved one's income. See, a lot of
Mhm.
people find themselves struggling at the funeral home, not because of the passing of a family member, but the passing of the family member's check. How are they going to pay
Rolling
the
around.
electric bill? Say again?
I said they rolling around on the floor, and you thinking that they
Absolutely.
because they lost the person.
Absolutely.
They probably are, but they wondering how in the world are we going to replace the income when half of it left with the breadwinner? That's if it's a two-parent household. If you're a
That's
single
correct.
mom, then and you or a single dad, and your children depend solely on your income, they're rolling around because they trying to figure out what do we do now, and there's no money.
Absolutely. So when you're 25, 35, 45 years old, you might need a lot of coverage. But when you get to be 55, 65, 75, you see with the green line, it goes down. It's just like your car. When you get a brand new luxury automobile or any automobile at that particular time, they make you get full coverage. But when the car gets to be 25 years old, no one keeps full coverage on a 25-year-old car. You still
Mhm.
have insurance, but it might be called liability, right? That is as simply as I can explain it. Life insurance works the exact same way. You need full coverage when you're 25, 35, 45 years old, but when you get 55, 65, 75 years old, you might not need as much coverage. You might
And you
need
better
some.
spending money.
Yeah, you now if you look at the gold line, it says in your early years you don't have a lot of money. When you're 25, 35, 45, and you're just trying to get this thing moving as far as saving and investing, you really don't have a lot of money because a lot of money goes out the window, right? It goes to your bills, it goes to your kids.
Right.
Everyone knows that struggle, right? But
Mhm.
when you're 55, 65, 75, and the kids are grown, the mortgage is gone, the debt should be eliminated. I'm not talking about living expenses. I'm not talking about your cell phone bill. Okay, that's not a debt. That's a living expense. You don't have to have it. But to live the way you want to live, there's an expense. There's a price for convenience. So when you're 45, 55, 65, 75 years old, you need to have some money. So if you had the money at, let's say, 65 years old, a $500,000, $300,000, $600,000, there might not be a need or a desire to have as much life insurance as you had as you were building the estate. Did you all hear what Letha said? You can rent an estate until you build an estate. This is what
Mhm.
she's talking about, ladies and gentlemen. You can purchase a life insurance program when you're 25, 35, 45 years old. You're renting an estate until you can build an estate that you might not need that coverage when you're 55, 65, 75 years old. Most people at 75 years old do not want to pay a life insurance bill, right? Most
Absolutely.
people at 75 years old want money coming back into them instead of money going out to pay a bill. So, how do we do that? You need to get the concept straight. So,
Absolutely.
life insurance is just like your spare tire in your car. You
Mhm.
only need it in case you have a flat tire. Well, what happens if you never have a flat? You don't need the spare tire anymore. When you sell the vehicle, you don't keep the spare tire. The spare tire goes with the car. Why would you need a spare tire if you didn't have a car? Well, in your life, in my life, in Letha's life, in most of our lives, that car is our children, our mortgage, and our debt. Once the children are grown, the mortgage is paid, and the debt has been eliminated, we don't need the insurance any longer, or you might need liability amount. So hopefully that made sense to you. I try to explain things in a way that can be easily understood because this is not rocket science stuff. It's very easy stuff, and it's stuff that we're already doing, but because of the
Right.
verbiage and the convoluted language, people just don't really understand what's going on until it gets broken down.
Absolutely. On the show next week, we're going to be talking about all things investments, right? So, if we show you how to rent an estate until you can grow one, you certainly are not going to need full coverage. As Lenny says, if you save a 500,000, 300,000, whatever the case may be, you can certainly pay for your funeral services off the top because, again, your children are grown. Hopefully, they're not sleeping on your couch, right? Your debt is low, your mortgage is paid. You better have some spending money because in retirement, to have 3 meals a day at just $5 a meal, you're going to need at least $300,000 to be able to eat in retirement.
That's right.
So a lot of us are behind when it comes to saving the money because we can't, because we're paying too much for life insurance, right?
That's right.
The kind that you have and the kind that have been marketed to our communities are expensive and don't provide as much coverage. So when there is a premature passing of a breadwinner, there is a huge gap, right? So maybe you get some money to bury the person. Maybe you get a couple dollars left over, maybe 10 or 20 thousand dollars. But if you make $60,000 a year, you're at a loss. If you got this job insurance and you make $60,000 a year and you end up getting 1 year of your salary, you're setting your family up to fail. You're setting your family up to be in a situation of poverty, downsizing, going to live with someone else, losing the home, foreclosures, the whole nine. So we're going to talk a little bit, because we got about a half an hour. We're going to talk a little bit about those kinds of insurances. There's really only two kinds, but they have different names and things that are put in terms that you struggle to understand, and that's by design, so that if you don't understand and you don't read the fine print, you're sitting being taken advantage of and you don't even know it, and then when you're dead, you're not there to deal with the backlash from you not being informed. So we are here today to just show you and explain some things to you, and we're talking about the two different kinds, being whole life insurance and term insurance, right? So we're going to talk a little bit about both and what the value of building a strong financial house and why we use a certain type of insurance to do that. So Lenny, let's just talk a little bit. I'm gonna sit and role play with you, as a person who may have the wrong kind of insurance. I thought we'd do something a little bit different, and you would school me on me having the wrong kind of life insurance. So
Sure.
uh, yeah, so Lenny, I think I'm pretty good with life insurance.
Okay.
I I have a policy already, and actually I got three policies that I have to make sure that my family is good. I got about a $50,000 on each one of them.
All right.
So I'm gonna have about 150,000. My kids gonna be straight. So what is it that's different than what you're gonna show me? What's different?
Well, congratulations, firstly, in being a grown up, a fully grown adult, where you actually have some life insurance and coverage. I'm very, very proud of you in doing that. But I have a couple
Mhm.
key questions I need to ask you. Um, you have three policies, you said, right?
Right.
How many cars do you have in your family, Letha?
We got two.
You got two cars. How many car insurance policies do you have?
We just got one. We got like a bundle package.
Oh, okay. Okay. You're a homeowner. You told me you're a homeowner as well, right?
Yeah,
How many homeowners insurance policies do you have?
just one.
Just one?
Yeah.
Okay. All righty. Okay. So you probably have cell phones in your house. Your kids, they probably have cell phones. Do you have the
Ooh,
family plan for the cell phone for the cell
they're on
phones?
they're on a family plan, so
So
we could get.
how many bills do you get? Do you get one bill, two bills, three bills?
No, I just get one bill.
You just get one bill. Are you noticing the
Right.
theme here, Letha? Like, why do you have three life insurance policies? How many lives do you have? Or how many lives are you living?
I only got one life,
You
but
only got one life. Ain't that
yeah,
something? So wouldn't it
but
make
my agent
sense?
told me I could, if I had the three policies, that would cover everything.
Well, not necessarily. Because you just told me you have more than one car and you have one
Mm-hmm.
policy. You have more than one cell phone, but you have one policy for that. You have more than
Right.
one person living in your house and you have one house and you have the one policy. So
Mhm.
what you're actually saying to me is that there is a possibility to be properly covered using one policy. Isn't that what you're saying to me?
Yeah.
So are you aware that each time your agent sells you a policy, there's an additional policy fee? So you're paying three different fees when you actually could be having one policy and paying one policy fee?
No, I didn't know that.
Okay, well let me ask you. Now I don't want to ask you flat out how much you make, but let's assume if you would give me that, that privilege to assume, let's assume that you make $75,000 a year, Letha.
Mm-hmm.
And let's assume that you passed away, God forbid. You told me that you had three policies, and they are $50,000 each, which
Right.
means that your family, your beneficiary, would tend to receive $150,000. Is that right?
Right.
Now you make $75,000 a year, and you're taking care of people in that house, right?
Right.
So if you're taking care of those people, and the insurance gentleman would deliver a check of 150,000, how long would things stay comfortable in that house? Say 2 years,
Mm,
because 75,000 is your salary, and then another
mm,
75,000 is your next year's salary. 75 and
mm.
75, that's 150,000. How old is your youngest child, Letha?
10.
10. So what you're telling me is that you're prepared to take care of that 10-year-old until they are 12 years old. And then the money would be gone. Doesn't that make sense? So,
Whoa.
yeah, statistics say, and life insurance experts say, you need to have 8 to 10 times your salary. So if you're making $75,000 a year, 10 times 75,000 is, you probably need $750,000. Now, let me ask you
Mm.
something, Letha. Do you know how much you're paying for that $150,000 in coverage?
Um, if it just comes directly out, but um, I pay about 225.
$225 a month?
Right.
Okay, now if I'm telling you and I'm suggesting to you, and you now know that 150 is not enough, can we agree on that?
Yeah. But yeah, I can
But
agree
you
with
are
that.
terrified that I'm suggesting that you need $750,000 a year. But you're doing the math in your head, Letha. You're saying if
Mm.
150 costs $200 a month, $750 probably going to cost about $1,000 a month. Isn't that what you're thinking?
Yeah.
Yeah, it just makes sense based on what you're spending. But what if I told you, and what if not only could I tell you, but I could show you? You remember when we were kids in school, Letha? You remember show and tell?
I
Well,
remember
see,
show
I'm
it.
telling you the story right now, but I'm going to show you the story in a moment. Well, if there was a way where you can get $750,000 worth of coverage for the same money that you're currently spending or less, would that be a conversation you would like to have?
God, yeah.
Let's
I
talk
felt
about it.
and I've been underinsured. That's scary.
Well, we need to talk about it. And that's how I would address that, Letha. Thank you so
Mm.
much for role playing with me. I appreciate that. But
Not a problem.
that's how I would address that. One of the
Absolutely.
ways I would address it.
So that kind of coverage that I have, and I hear this often. That's why I brought it up when I'm sitting with people. I hear them say and brag about the fact that they got these three policies, right? And the three policies still doesn't add up to what they would need until their youngest child reaches the age of 18. And people are excited about it. For some reason they think the more policies that they have, the better off that they are, when really the amount of the policy
Correct.
still leaves coming up short. So they're bragging about having $350,000 policies when really they need 8 to 10 times the income, and they're short, right? And then I asked them, what does that mean for your children? How do they survive? How do they go on if they've been dependent on your income this whole time? And you tell them, I got these coverages and it's just gonna get me straight for 2 to 3 years. We are drowning in the lack of information, where we think that way, right? Or we think we're covered with the job insurance, and you don't own that policy. So you work at a job and maybe you work there 10 years and you got just what they call group insurance. They make all the decisions on that policy for you. And then when you leave, you're 10 years older with some health challenges. And now it's harder to get the kind of insurance that would grow wealth. We put so much stock into the job, taking care of our family. And then the job policy doesn't cover our loved ones either, a lot of the times. So these are just some of the things. I know that there are people out here who would need a whole life policy. Maybe, that for they're older, or maybe they, don't qualify for medical reasons or whatever. In that case, something is better than nothing. But if you're between the ages of 25, 55, even all the way up to 70, if you can get some different kind of insurance that positions you to pass wealth to your family, this is what we mean. And I want to pull it up, and I want to educate people on the difference between whole life and term insurance, and why this conversation is so important. Thank you, Leslie. You on point, my girl. You on point. So we talk to people about buying term insurance and investing the difference, because we don't just need money if we pass away prematurely. We need money if we live a long time. And when you're building a strong financial house, this is a part of it, right? That foundation needs to be secure and sound. And I just spoke about the $50,000 that people are excited about having, right? We're excited to have these $50,000, or even two to equal 100,000, and we think we're doing good, or we got $50,000 with a bundle package in our State Farm. But it's, oh, sorry, I shouldn't have said that. But in our car, a bundle with our car insurance, but we actually don't, we're underinsured. So I wanted to kind of talk a little bit. You can do the left side, I'll do the right side. And I want you to kind of talk about some of the different types of insurance, the names that they hide behind, and why they may not be very helpful when you're trying to pass wealth. So
Okay. All right. So you said a mouthful there. One of the things that you said in our role play, was $50,000 worth of life insurance. Well, there it is. What you
mhm,
also said is that someone might bundle their insurance with their auto insurance company,
sure,
and that kind of makes sense. But let me ask you, Letha, if you could role play with me for a moment.
absolutely.
Would you buy furniture from your local Wawa?
No, no.
No, you wouldn't, right? Because Wawa doesn't sell
Absolutely.
furniture, first of all. And even if Wawa started selling furniture, you understand Wawa to be a gas and coffee company. Is that correct?
Correct.
Okay. So here's the gotcha, is that if they're selling you your auto insurance and you get a bundle package, it almost sounds too good to be true. Like they are not going to take advantage of you, right? Because they're in the insurance business. But there's two different types of insurances. Some life insurance companies are straight up whole life, some are universal life, some are variable life, some are straight pay life, some are you know life where you don't have to pay anymore, those types of things. But let's just address the elephant that's in the room right now.
Mm-hmm.
What I hear, and maybe you do too, Letha, I hear that term insurance runs out,
Mm-hmm. I've
and
heard that.
I need insurance for my whole life. Do you hear that?
Mm-hmm. All the time.
Well, what I say to those people are simply this. If you purchase a mortgage, would you like to pay your mortgage your whole life? Doesn't your mortgage have a beginning and an end?
It does.
Doesn't your car payment have a beginning and an end?
Absolutely.
If you were paying a installment loan, doesn't that have a beginning and an end?
Absolutely.
Why wouldn't you want your life insurance to have a beginning and an end? And the answer that I receive typically are, I don't know. Well, if I could show you how to have enough money that you could either drop down the liability like we talked about,
Mm-hmm.
or maybe even eliminate the responsibility of paying for a life insurance program because you have enough money. Please understand that people who have a lot of money, unless they have a business, typically don't have a lot of life insurance. There's really no need for it
You're
because they
self
have a lot of money.
right. You are
The,
self-insured. You can pay for whatever you need to pay for off the top.
the objective is to build a lot of money.
Absolutely.
You said to your audience, rent an estate until you can build an estate. Well, building an estate, it might take 25, 30, 35 years.
Mm-hmm.
Well, if you're able to build an estate where you have a half million, 400, 500, $600,000 in cash, you might not need the life insurance program. So let's get right into the left side. Ladies and gentlemen, you can see in the middle where it says $100. You can see where it says whole life on the left. I'm going to explain the left. Letha's going to explain the right. For every dollar bill that's used to spend on a life insurance program that happens to be whole life, and one of the signifying differences are simply this: you can borrow from your whole life insurance policy. I'm going to get in that now. I'm going to address that in a moment.
Mm-hmm.
You have a whole life policy, so it takes $40 to get $50,000 worth of coverage. So my question to the audience, Letha, if it costs $40 to get $50,000 worth of whole life, why do I send them $100? Because it
Right.
only takes $40 to insure the family. Well, you send the whole
Mm-hmm.
100 because 60 of it goes into this thing called cash value or your savings program. And that sounds so good, Letha. You need insurance, you purchase insurance, you need savings. How they sell it is, Miss Thornton, have you ever had a financial challenge where you might have needed some money from time to time?
Yeah.
Who is
Yeah.
going to say no to that answer, Letha?
Right.
Everyone's going to say yes. So saving money sounds good, and it
Mm-hmm.
is, but you can save money in the wrong vehicle. So
Sure.
let's take a look at it. On the left-hand side, it says the money that's going into your cash value, that's the bottom portion of this particular policy. You're getting a zero balance for the first 3 years. Let me say that again. You're getting a zero balance. Who would sign up for this particular program, Letha, if they
People.
knew that you were
People.
getting a zero balance for the first 3 years? Anybody out there?
People that don't know, they get excited. What I've noticed is that people are hyped to borrow their own money.
Makes
So they get
zero
hype
sense.
about it. Makes zero sense. People get excited. Oh, you're gonna be your own bank and you're gonna be able to
Oh,
do
don't
all
get me started on infinite banking,
that.
ladies and gentlemen.
You be your
That
own
infinite
bank,
bank.
but you can't be your own bank for 0 to 3 years. I've seen on someone's policy where they couldn't be their own bank for 5 or 10 years because it's you're paying this $100 and their life insurance is being paid, but they're saying that the $60 you won't have access to. So even when you have a hardship, you haven't grown really any money in those first 0 to 3 years or 1 to 3 years. That's terrible.
Well, they use fancy language and they
Mm-hmm.
say something like, well, you haven't accrued any dollars, and we're not or may not know the word accrual. We may not have heard accrual, and we just don't want to appear as we don't know, so we let it go. So the industry has been designed purposely to confuse the consumer. And for all my infinite banking players out there, owning your own bank, let me just say this to you: banks get paid to lend people money. That's how banks make money. So if you are a bank, you're not making money if you're not lending money to the consumer. See, the banks take our money in from payroll checks, and they lend the money out in the form of mortgages, credit cards, student loans, car payments. They
Mm-hmm.
take our money and give us a low rate of return. If you look at number two, low rate of return, 2 to 4%, very, very low. And they lend out, I mean, the average credit card now is 29%.
0.9999.
0.99, excuse me.
Yeah, put that on there because
So
it's
if you put money in your bank, your infinite banking, ladies and gentlemen, where do you go where you can go get 30%?
Hmm.
Where do you loan money where you can get a 28% return on your money, ladies and gentlemen? So please stop it with the infinite banking. It's nothing more but a unique marketing ploy to sell the same garbage that they used to sell.
Mm-hmm.
Okay, let's take a look at number three. You borrow your money. If it were your bank, ladies and gentlemen, why would you have to borrow your own money from your own bank? That
That
doesn't
is
seem
one
to make sense.
That's what they say. Like, I have the ability to borrow the money if I need to. And I was like, where do you bank? And they're like, oh, I bank at TD. I said, if you went into TD to take the money out that you put in there and they told you to fill out a loan application, how would that make you feel? And they said, well, I would turn that bank out. I'd tear everything up. I said, so why would you do that with this cash value? In order to get it, you gotta borrow it. Borrow your own money. That's $60 that you've been putting in there all that time. They're telling you to borrow it from yourself. So if you're borrowing it from yourself, it's probably not your money, right?
But you
That's
know, Letha, how they get them is they trick them by saying, you can borrow against this particular banking system or your policy, and you could pay yourself back with interest. And some kind of way that makes sense to people sometimes. I just never understood it. I had a 401k when I was working on the job. I was putting 17% of my income into the 401k when I was a younger man. I wanted to go buy a car. I wanted to check my balance of my 401k. And they told me my balance. I said, well, I need to buy a car. The car I want to buy is $22,000. They said, we'll loan it to you.
mm,
And you have to make payments not only to pay the interest back, you pay it back at a higher rate of return. I said, let me get this straight. The car I want to buy is 30 something thousand, but I got 20 something thousand in here. So I'm going to get 20 something $1,000 out of my 401k, give it to the car loan people, have a $10,000 note where I got to pay car payments on the $10,000. And you're telling me I have to pay back the $22,000 with interest? Why would I want to pay
mm.
you interest or pay myself back interest that if I needed a loan again, I would have to pay some more? That just doesn't make sense.
Nine
Who
times
wants to
out of
pay themselves interest?
if
I
you
want to
had
earn interest, Letha. Oh, I love earning interest. I don't like
right,
paying interest to anyone. Take
that's
a
the
look at
God's
number
honest truth.
4. I'm sorry, go ahead.
If you had the money to pay it back, you probably wouldn't need to borrow it, right?
In the first place.
In the first place. So 9 times out of 10, people are not paying the money back to themselves, and that creates a whole different set of circumstances. And I'll let you talk about that.
If you die, or not if you die, but when you die, do you understand that the company keeps the savings that you saved up for all of those years? See, that $60 that goes to build that $10,000. Firstly, for the first 3 years, there is no balance. How would you like to go to Bank of America, been putting money in Bank of America or in your infinite banking life insurance product for 3 years? You're putting $60 in there for 3 years. That's 36 months. We know how to do simple math.
Mm-hmm.
$60 times 12 months is over $700. So 700, 700, 700, right? You got over $2,000 that you put into the savings portion of your policy. And you're expecting to have $2,200 in there. Well, when you
Yeah.
go check that account, because of the first 3 years, it has no balance. Your balance is zero. So now you die. So you found out that you had zero, but you eventually got up to 10,000. You never borrowed against it. So when you die, your family's going to get the 50. What happens to the 10,000? They keep it, ladies and gentlemen, and you sign for it. You sign for my infinite banking customers. You sign for it, my whole life customers, my variable life customers, my universal life customers. You signed on the dotted line. You essentially made the insurance company your beneficiary because they're going to keep your savings, and it's legal.
And you could really look at your own policy and it will show you this. Now that we're enlightening you on it, there's a loan surrender page, or it shows you accrual stages of your policy, and you can see for the first 0 to 3 years or maybe more, no money's growing there. They're saying it's going toward administrative fees. So if you die, the company keeps it. If you borrow it and you don't pay it back, the company then takes it from the 50,000 plus interest. So we've had people who thought that they were getting 25,000 and they really were only getting 13 because back in 1992, Big Mama borrowed from this and didn't pay it back.
That's
So
exactly a fact, because you pay it back at 8%. You never pay it back because they make it seem as though it was your money. They never send you a bill for you to pay the money back. They just tell you in your policy you're supposed to pay it back. Well, that money has been growing at 8%, like Letha said, from 1992. That 10,000 grew to be about $40,000.
mm-hmm.
Now you're getting 40, 50 minus 40 equals 10. The
Hmm.
funeral home wants 13,000. Now you find yourself on Facebook putting up a GoFundMe page to raise the additional $3,000, going to the church here in 2023, still having bake sales,
Mm-hmm.
going to the neighborhood, talking to your local politician, because we cannot afford to dig a hole and a pine box for our loved ones. It's a crying
Come
shame.
on. It's a crying shame. So the question remains, if you got to borrow it to get it, if you die, they keep it. And if you use it, they take it back from your family. Who the heck did you save this money for?
The insurance company.
So you didn't save the money for you. You get it in the event of a upfront hardship, and you be so pressed to handle whatever the emergency is that you don't look down the road, and then your family pays the price. So
Let alone, Letha, as you accurately described, 50,000 is not enough coverage to begin with. Because if you're making
how about that?
75,000 a year and someone is gracious enough to deliver 50 to your family, your family will be okay for about 8 months. Then the money is gone. Then what? You still got mortgage bills. You still got electric bill, gas. Got to send kids to karate school. Got to send kids to football practice, dance class. Still got to pay your car payment, car insurance,
Mm,
homeowners insurance.
you're
Life
about to be
still goes
short.
on.
You're about to be short, right? So what
Absolutely.
we teach people, right, is that if you do this properly and build your financial house the way you need to, we can teach you how to do something different. So, what we say with that same $100 that you were paying for the whole life, we split it because we don't want to buy furniture from Wow Wow, right? We want to separate our investments, the living money from the dead money, right? The money that somebody's got to die to get, we want to separate it from the investments. So we give you 60, you take $60 and get yourself $250,000 in coverage. And the rates have certainly dropped. So you might even be able to get more than that. But $60 gets you 250,000 in coverage. We save you $40 because this is straight insurance. So we're gonna save you $40. You take that $40 and you put it into an investment over the time that you have the coverage. If it's a 30-year, a 35-year, whatever it is, you grow that money over the time period that you have the life insurance coverage. You grow more money than you would have in the whole life policy, and you certainly could pay for your funeral off the top, and the family has more money because they get not only the 250,000, because we have separated it, the family gets both, right? So they get the 175 that you thousand you've been saving, and then they get the 250,000. One is not associated with the other. And then whatever money you put in, your $40, that's a magic number in some people's world. But that $40, you have an instant balance. So if you went and took the $40 the next month, it is yours to take, right? We're going to talk about percentages and interest rates and things like that next week. But you have a higher rate of return, so that $40 grows a lot faster than you having paying $60 and it growing to 10,000, right? It's your money to withdraw, so you do what you want to do with it. And like I said, if you die, your family gets both, right? What people bank on is that we can't save money. They bank on the fact that we're not disciplined enough to save money. So they'll say, well, people are not going to really save no $175,000. So they might as well just get the whole life policy. But we are here to change that, right? We want to put you in a
Absolutely.
to be able to do that, so you can rent the estate until you grow the estate. If there is no reason for you to be paying on something your whole life, right? Because you certainly can see that this is probably a better situation for you to be in, right? So they just dress it up and call it different things. Lenny just explained the infinite banking. They'll talk about IULs, indexed life insurance policies, where you're
Index
overfunding.
universal life.
Yeah, index universal life. You're overfunding your policy, so
Absolutely.
you're ending up spending $300 and $400 a month to overfund it. If you are living paycheck to paycheck, that is a recipe for disaster, because you're overfunding something that you gotta die to get, right? And they'll dress it up and say that it's a retire, you can use it for retirement, or you can use it for this, or use it for that. You're still having to borrow money from yourself. And then if the rates of the insurance go up, then they got to take money from that whole life policy
To pay the
to pay
premiums.
your insurance,
That's right.
right? So it's a setup, it's a trap. And I am encouraging everyone to get with a financial professional, a financial coach, a financial advisor, because insurance agents will try to sell you on that because they don't have the proper licenses to show you how to grow the money properly, right? So
Absolutely.
they'll tell you, use this cash value as a way to fund your own bank, or use this, because they are not investment licensed to show you how to invest in the proper vehicles to do the full job. So the last thing that we're going to show before we let you all go, because we are over our time, Leslie, if you could show what it's supposed to look like when you do this thing properly, what mom and dad, and I'll let you break this down, Lenny, because you I know that you have done this with your own family and you've explained it, but the family tree should look like this, you all. And if
Oh,
you're not doing this, I strongly suggest that you get with one of us, because we are both licensed representatives, and we can show you how to implement this plan so that you can become an owner instead of having to get loans to borrow your own money and all of that. But this is how we can stop passing poverty, create generational wealth, and show people how to leave a legacy. We're not doing this. Rappers aren't doing this. The everyday person that's doing a GoFundMe or whatever the case may be, or just trusting the job insurance, or my mama got insurance on me. We're not doing this. So go ahead and break it down, Lynn, about how we do this.
well, this is something that I actually am doing. This is not a theory. This is what I'm actually doing, and I love what it has right here. 13, Proverbs 13:22. A good man leaves an inheritance to his children's children. I believe in that, and that's what I'm trying to do. So if you got a
Right.
grandmom, you got a grandmom and a grandfather. They got $250,000 in coverage each, which means they have a family of $500,000. Well, see, what's going to happen is they're going to have children. They're going to have child one and child two, right? Most families have two children. Some people have more than two, but
Mhm.
most people have uh, two children or more. I happen to have a rich man's family. I got a son and a daughter. The son was
Mhm.
born first. So I did it right. I did it right. All right.
But
I did it right. So if you got $500,000 worth of coverage and you got child one, and let's say child one gets one person's insurance, which is $250,000, and let's say child two gets grandmom's insurance, that's $250,000, right? They both get 250. Funerals at that time might cost 20 grand, right? Or less. Let's say that they learn how to invest 100,000 of that particular 250. That leaves, about $500,000 is what they were getting. That leaves some money. And then what you do with that money is that child one and child two are probably going to grow up, get married, and have some grandchildren. They're probably going to have grandchild one, grandchild two, grandchild three, grandchild four. That's simply how that's going to happen. And what they want to do is they want to set that next generation up so that they could get the money moving, right? Because we don't have any rich uncles leaving us no money. We don't have no rich family members that are leaving us a business, right? So one of the ways of becoming wealthy here in America is through life insurance, ladies and gentlemen. We want to encourage you to get involved in business, get involved in saving money so you can leave a business to your family, get involved in investing so you can leave a pile of money on top of the life insurance to your family. We would encourage you strongly to do that. But let's say you didn't do that, that's not your deal. Well, you got grandchild number two and one, two, three, and four. Leave some money to those grandchildren. They're taught to get a life insurance program, just like child one and child two had a life insurance program, just like grandmom and grandpop had a life insurance program. They paid once, and then the money came in. Then they don't have to actually pay as much because they got the cash to do it. They invested $100,000, but they got a life insurance program too. But it's not a hardship in them paying for it because they got money in the bank. But they do it, right? So they got these four grandchildren. Well, guess what happens? They're going to leave them children some money because child one, child two are now mom and pop. See, there was grandmom and grandpop, but left the children behind. They became moms and pops. It's like you and I. Right? See, if you and I had, I have a brother. My brother has two kids. I got two kids. See, this is real life for me, right?
Real life.
See, when I have two kids and I set them up with I have a life insurance policy on me and my wife, and we pass away, they're going to inherit the money. And in my will, I'm going to designate that they need to get life insurance so they can take care of my grandkids, right? It says here, right here, Proverbs 13 and 22, a good man leaves an inheritance to his children's children. Well, how are we going to do that? One good way of doing it is providing a life insurance program that can deliver a death benefit so that the mom and the pop, that's me and my brother, me and my wife, him and his wife, can get a life insurance program on us so that when we expire, when we check out, when we pass away, we have an untimely demise, whatever term is comfortable for you. When you leave this earth, you leave something behind, and that is a bunch of money, ladies and gentlemen. And some people are visual learners. I know that I am. This might make better sense to you, but please take advantage of the opportunities that are presented before you here this evening. Letha, you have done a bang up job this evening.
Thank
It's
you.
been my pleasure to spend some time with you and your audience just talking about the fundamental game plan of your brick house, which is having the money keep coming in. That's one way of doing it is through life insurance. So back to you.
Absolutely. So hashtag generational wealth, hashtag end generational poverty, hashtag woke, hashtag moving the culture forward, hashtag do you know that if we all purchase these types of policies, there's a TikTok that I may share next time, they would stop the killings of unarmed black people by police because insurance companies got all kind of lawyers, and if we all had policies and they had to cough up this dough, they would lobby, they would do whatever they could to make police tighten up on how they handle themselves because they don't want to pay these death claims. But consequently, we not saying that that's the answer to all of it, but we don't have a lot of the times we don't even have the insurance. So nobody is really suffering except the family that's left behind. These insurance companies aren't having to pay off two and three and $400,000. There's levels to this stuff, people, and we're not adequately being prepared to do these things. So I encourage you, watch this, share this, watch it over and over again. Our views are going up every single week because we're trying to provide content and the way for you to level up in 2023 as it pertains to getting your money world right. So, we want to thank you for your time. If you have questions or you want to know more, Lenny, how can they get in touch with you?
I'm gonna do something that I hardly ever do, Letha. I'm gonna give people my personal cell phone number. It's to this phone right here. If y'all can see that, this is my personal cell phone number. It rings, I answer it because I'm not afraid of answering the phone because I know it's not a bill collector.
Right.
My number is 609. I live in the South Jersey area, 609-892-4830. That's 609-892-4830 is my personal cell phone number. That is probably the most direct and the best way of reaching me. If you want to leave a message, you can certainly do that. If you want to talk live, we can certainly do that as well. I'm Lenny White on all socials, but the best way to reach me is my cell phone.
Absolutely. And for me, if you want to ask questions, you want to pick my brain, you want to talk about some of the things, hopefully, like we've plugged business owners and things like that on here because we all want to eat. And when we have people on the show, we can not just share information, but don't take the information that you heard on here and go give your business to someone else, right? Because that's like us showing you the car, letting you smell it, letting you drive it, and you go let somebody else sell it to you and they get the commission. If you value what we share, patronize our business, right? You can reach me. I'm at 484-297-2111. Again, 484-297-2111. I'll be happy to sit down and customize your insurance needs to you. Not no one size fits all, but I will be glad to show you what your insurance needs are based on what you have going on in your life and what holes would need to be filled if you were unfortunate and your family has to deal with a premature passing. Let's put our families in a position where they don't have to mourn us and mourn our paychecks. It's hard enough to mourn a breadwinner, but it's even harder when there's no money left behind. So with that being said, we hope that we curb your desires to do GoFundMe accounts. We hope that we curb your desires to do fish fries, pass the hat, pass the bucket, whatever it is. We're providing quality information. The information is free. Feel free to reach out to us, and we hope that you got value in what we shared today. So thank you and have a good night.
Good night.
CMPRadio.net, it's the station. Listen, man, let's cultivate together. Bring us all your show ideas. Content creators, we're looking for that. Videographers, we're looking for that. You can be a part of the next great big thing that takes place right here in Chester.